Let's connect with Dhawal Dalal and Akhil Mittal. Dhawal and Akhil, good evening. Thank you so much for joining in today. And first question, Dhawal, how would you explain the rate hike pause?
I think what the Reserve Bank of India has done has clearly surprised the market participants, but it's the right thing to do. We always believe that the April policy is going to be a close call, given the fact that inflation after rising in Jan and Feb is likely to trend lower very sharply. And as per RBI's own forecast, it's going to be Q1 average inflation is going to be close to 5.1% as against 6.4% that we are seeing right now. So inflation is going to be far better from market participants' perspective, whereas the economic growth is something that everyone is feeling that given whatever has happened in the global financial markets with regards to banking crisis and other things could possibly pose a headwind. Now here the RBI is probably an outlier in terms of their growth forecast for FY24, where they are talking about growth at close to about 6.5%, whereas most of the other market participants believe that the growth could be lower than 6.5%. So clearly the government ahead of the election and the RBI being the banker to the government are clearly aiming to ensure that the growth remains in focus and priority. So from that perspective, holding rates at present level, particularly when inflation is going to trend lower, and give the market some time for the previous rate hikes to start acting is probably a prudent thing to do in our view. So from that perspective, I think the market participants will probably rejoice the current move. The only thing that we need to keep in mind is that the inflation, which RBI governor themselves has said that they are vigilant about it, should probably remain on the expected path and should not throw any kind of negative surprise going forward. Otherwise, RBI probably rate hike is going to be back on table in June.
Which is why I think this pause. But then let's dissect this one by one. And Akhil, although there is a pause, but there is no such signal of it being one of the many. In fact, there are indications that it could be one of the pause depending on the global trend or the global scenario. Now, how would you look at the global scenario right now and compare it, or maybe analyze RBI's today's move in context with the global trend?
So to start with, our expectations, we were an outlier in the market. We had expected a pause in the policy. And now, RBI has done a cumulative of 290 basis of effective tightening in the system from 335. The operating rate is now at 6 quarter. It takes time for these things to, then percolate into the real inflation numbers. And also given the fact that the repo rate is already ahead of the current inflation number, it's not that any further rate hike would have helped the economy in any which ways or tackle the inflation in much harder ways than it already is. Now, RBI sounded off concerns on fragility of financial system globally. Now, those concerns are for real. It's not that we can remain aloof from what is happening around in the world. So, especially the sentiment side of it, and given the fact that expensive money will have its impact on credit growth going forward. That combined with the bad sentiments, if they were to prevail, would not bode well for the growth of the economy. Now, we have to remember that 2022, RBI front-loaded the rate hikes to tackle inflation head-on. And once the animal of inflation is under control, it cannot actually give away the goal of growth. To nurture and foster growth over a longer period is also very important. So I think in that backdrop, given that global financial markets are passing through a bit of turmoil, are passing through a bit of uncertainty, it's a wise thing to do that. Give yourself some time, see off the volatility in the market, see off the fragility in the market, and thereafter have a fresh look at the numbers on how they how they transpire, what's the trajectory unfolding like, and that's how I think today's policy was expected, at least at our side, and that's how it has largely been portrayed. As far as one-off or consistent is goes, I think it's not a one-off. Given the trajectory of inflation that RBI has printed, you really have to have a out of whack negative shock on inflation for rate hikes to be back on table. Minus that, I think we are done. When RBI says it's a one-off, it's a pause and not a pivot. It basically means on a timeline and not on the scale of rates going up or down. So I think the pivot point in terms of absolute number is close. In terms of timeline, might be slightly away, but definitely as far as our reading goes, we do not anticipate any further rate hikes.
Mhm, mhm. All right, Dhawal, now let's talk about the inflation number, which came marginally low in terms of expectation that the RBI has quoted. Take on this?
Well, I think right now the RBI has basically reduced the inflation forecast or average inflation forecast for FY24 based on the reduced crude oil prices from $95 average price to about $85 in average price. Now we just hope that the oil prices remain where the what RBI is trying to project, given the fact that oil prices have remained pretty volatile in the past, and given what OPEC Plus group is trying to do with regards to raising oil prices, this is something that market participants are keenly watching. Now, at the same time, we are all aware of the fact that global economy is going through a little bit of slow patch, right? So, a slowing global economy will reduce the demand for oil, whereas on the other hand, the Chinese economy is now gradually improving. So, you have the push and pull from both sides, which is going to be interesting to watch their impact on the oil price going forward. But we would believe that given India is able to buy crude oil from Russia at a discounted price, and then there are other resources as well. So we believe that crude oil prices should remain below the expectations. That's one thing. Second thing is the food price. I think right now the food prices remain very, very important for us given their weight in the index, in inflation index, about 40 to 45%. And currently we are seeing there's a lot of volatility coming in the food basket. We look at the milk price, you look at the wheat price, you look at some of the pulses and some of the protein prices. I think they have remained pretty volatile, and this is something that we will have to keep an eye on, particularly at a time where weather-related vagaries are keeping food prices volatile. So these are the two main aspects which we believe are likely to play an important role going forward on the trajectory of the inflation. And this is something that we'll have to watch. And I think the Reserve Bank of India is keeping their fingers crossed with regards to expecting a normal monsoon and lower negative impact because of the El Nino, and energy prices remaining in the check. So these are the three things we will be watching. And if there is any significant deviation, that's why RBI has probably kept the door open for a potential change in the monetary policy down the road.
Okay, what about the currency weakness? Do you think the pause will impact the currency movement and maybe a hike would have stopped the weakness? Okay.
Not really. I mean, yes, at the margin, you can say a hike would have slightly, being more favorable towards rupee. But actually, if you see, there's no material change that a hike or a non-hike has done to the currency, given the fact that our deficit numbers have improved significantly. The exports have increased and imports have also been managed well. Also combined to that fact that we are some of the EMs, favored EMs, we are one of them. So the flow of money is okay. The trade packs are going okay. So I don't see interest rate defense wall being needed to heighten to manage currency. In fact, if anything has to go, I think we have already reached a height of defense wall, which is apt and optimum. I don't see any reason why RBI would have been too concerned about INR and then use the rate as a defense for that.
Well, now if we have to talk about the yields now, what do they indicate?
Currently, I think the market has reacted in knee-jerk manner the way yields have declined. But as the dust settles going forward, we do expect the yield curve to start bull steepening. That means short-term rates will probably fall more faster in terms of a basis point as compared to long-term rates, long-term yields. Now, over here, I think at the short end, we know that the 1-year T-bill was close to about 7.25%, based on the expectations that the repo rate will probably be 6.75% or even higher down the road. That is what is being priced, and now it is going to get unwound. So we do expect short-term yields to gradually trend lower. On the long end, on the other side, I think given the first of the borrowing program has increased the amount of option for 15-year plus portion of the yield curve, and given the recent changes in the tax law, if it's going to make a material impact on the demand of the long end of the yield curve, we could probably see the long end of the yield curve remaining a little stickier, whereas the short-term yields will gradually start trending lower as market participants begin to factor in a pause for calendar 2023 and potential rate cuts down the road. So, from that perspective, we do expect the yield curve to gradually start steepening from here. And importantly, whatever happens in the US treasuries will also have its impact on the sentiment of the market participants.
So when you talk about double steepening, what is the number that you're talking about?
So we do expect the 10-year to trade in a range of 7.15 to 7.25% in the near to medium term, given the fact that with repo rate close to at 6.5%, and the average term premium from about 70 to 75 basis points. So that's where the fair level for the 10-year will be close to about 7.25%. But given the significant improvement in sentiment among market participants and the need to add duration, given the robust flow that we have seen in the last week of March, I believe that the 10-year yield is likely to trade at the lower band of its trading range of about 7.15 to 7.25%. Whereas on the 5-year, we believe that the spread between 5-year and 10-year should gradually start widening, as the 5-year will also get pulled lower during the steepening process.
Okay, what's your take?
I think for now we'll be in 7.15, 7-quarter zone, as Dhawal has mentioned. But going ahead, I think 6 months, 9 months down the line, we should be moving towards 10-year benchmark GSEC should be moving towards 7% or lower. Our entire premise is that as inflation comes down, every policy RBI will give you a 12-month forward trend chart. As soon as you see the forward inflation number, 12-month forward inflation number moving sub 5%, that point in time you cannot have a policy rate of 6.5. I think you will be looking at or discounting a repo rate cut then, which means it has to translate into market yield. So towards end of financial year, maybe end of Q3, Q4, we see 10-year GSEC sub 7%. As far as steepening goes, we see a parallel shift in the system, given that withdrawal of accommodation continues to be the stance, and RBI has said that liquidity is an important parameter of accommodation or withdrawal of accommodation. So we believe liquidity will remain very closely managed in such a way that RBI keeps operating rate the way they want policy efficacy to be. So in that sense, short-term curve might not react as sharp as what it did today. So we think a parallel shift and not really a steepening or a flattening, but a parallel shift in yields going down the line.
Last question to both of you. First, I'll start with Dhawal. Dhawal, time to lock in money for longer term now in fixed income? What do you suggest?
Well, we'll do like the area between 5 to 10 years part of maturity bucket on the yield curve. We believe that the long end is likely to remain stickier depending on the demand supply dynamic that evolves as we discussed. But at this point of time, I think 5 to 10 year segment looks very, very attractive from relative liquidity as well as risk adjusted return perspective as well. So we are advising clients to focus on 5 to 10 year segment of the yield curve with at least 3 to 4 year of investment horizon.
Investment instrument that you're recommending, given the fact that taxation benefit has gone on debt funds? Dhawal?
Yes, I think market participant will start looking for absolute return kind of returns, and from that perspective, I think the 5 to 10 year segment will probably give a decent carry plus potential price appreciation down the road as and when the rate cuts cycle begins next year. So from that perspective, I think it will probably provide a good carry plus potential price appreciation from 4-year holding period perspective, in our view.
All right. Akhil, what about you?
I think time to lock in money for longer durations, both on absolute and relative basis. The study is simple. Ever since MPC formation in May 2016, when it became a law, the paradigm of interest rate setting has changed. From then till now, we have largely 10-year GSEC is traded in range of 6% to 8%. Currently at 7-quarter zone, we are at 65-70% cheaper prices. now related to the inflation dynamics that have emerged in the country. When we were at 9% inflated economy, we used to trade at 7.5. When we were 8% inflated economy, we used to trade at 8%. When we were a 7% inflated economy, we used to trade at 6.5, 7. We are a 6.5% inflated economy going ahead. If you are going to be a 5.5 or a 5% or a 4% inflated economy, you are not going to get these yields. So going for longer duration, longest durations possible. It will take time for the interest rates to actually come down by a great deal, but over a period of time, you will see inflation coming off and interest rate yields or yields coming off across the curve, entire duration curve. So pick and choose depending upon your investment horizon, your risk appetite. I would say going for longest duration.
Right. So, right time to make the most of the interest rates which are high as of now. Thank you so much, both of you, for being on the show and helping our viewers and helping them understand the purpose behind the RBI policy today. On that note, we'll take a quick break, and post that, let's get your tax planning done for the new financial year. We'll help you understand whether you should be sticking to your old tax regime or it's the time to move to a new tax regime. And if you are someone who still wants to stay with the old tax regime, what all you need to do now as per your tax planning after the break.